Hello, welcome to lecture 2 of module 5. In the previous lecture, we discussed about the preambles of predictive models using financial ratios to delve into the future financial states of affairs of the company, which are essential on the part of the users community to arrive at different decisions, to execute different policies, and at the same time to devise strategies in order to counter their peers in the corporate world. Now, in this lecture, we are going to deeply discuss about one of the most celebrated model which is used by the users community with regard to appraisal of the financial states of affairs and specifically the quantification of return which is expected of a shareholders orientation. Now, to move further, when you are going to talk about DuPont model, it is a model which is propounded by the DuPont company, which is an US based body corporate, and introduced that model by using financial ratios which is going to address the return on equity specifically by decomposing the return on equity calculation into different financial matrices. Before getting into the DuPont model exclusively, we must know what is the utility of this particular model at the end of the users community. We all know that financial performance can be measured by using different parameters. There are certain accounting measures which are leading to return on capital employed, return on investment, return on assets, and so on and so forth. On the contrary, there are certain contemporary measures which are based on the economic value added orientation, say for example economic value added, market value added, shareholders value added, and so on and so forth. But so far as the usability is concerned, at the end of the users community, or to be specifically the stakeholders community, it is always having a biased orientation when we come to the use of DuPont model, and which is a proxy of the return which a particular body corporate generates from the point of view of equity shareholders. Now, why is it so popular? It is simply because of the logic that the equity shareholders are the real risk bearers of a company when we look at the capital committed in the company at the end of different providers of capital. There are certain other providers of capital, say the providers of debt capital. But when we are talking about the debt sources of capital, we all know the providers of debt capital, they are not at all interested to share the risk which is inherent in the business. Rather, in other words, we may say they are not bearing any element of risk which the business is exposed to. So, essentially, so far as financial parameters are concerned, they are treated as outsiders to the business or to the body corporate. But the equity shareholders, they are always treated as insiders, and they are otherwise designated as the real owners of a business. Now, being the real owners, whether they are able to get sufficient return on their capital investment vis-a-vis the risk what they are bearing with, and whether that risk and return relationship is optimal or not, that is one of the cornerstone of the DuPont model, which is used by the users community in its extended version. Now, essentially the model, when you are going to talk about DuPont model, it is sometimes referred to as the DuPont analysis or DuPont identity, and it is a framework for measuring the financial performance that divides a company's return on equity into multiple parts. This aids managers and analysts in comprehending the primary forces behind efficiency and profitability. Now, from this elementary definition of the DuPont model, we can apprehend that DuPont model accommodates the whole of the states of affairs of a business by accommodating the profit making ability of the company in one hand, and at the same time the level and extent of efficiency with which different operating activities have been executed in the business, that also has been taken into consideration while we are talking about DuPont model. And there are the decomposition of the financial performance when you are going to talk about the return associated with equity shareholders, and that decomposition is scientifically executed with the proposition of this particular model. Moving further, when you are going to talk about the decomposition of the financial performance exclusively for the equity shareholders who are otherwise the owners or insiders to a company, there lies three different components. One is net profit margin, the second one is asset turnover, and the third one is equity multiplier. Now, all these three components are more or less accommodating each and every dimension of business in terms of financial orientation. How can we say so? We can understand the same by deeply delving into these three subcomponents of DuPont model. When you are going to talk about the net profit margin, obviously we all know what is meant by net profit margin. When you are going to calculate the net profit margin, we are essentially accommodating all the operating activities which are getting executed in the business, and by offsetting all those activities which leads to expenses at the end of the business community against the revenue generated by executing sales activities, that leads to net profit margin orientation. Now, when you are going to calculate the net profit margin and we are looking at the business or the body corporate, it is clear that all the activities are falling under the purview of net profit margin and its calculation when you are going to talk about the first component of the DuPont model. Moving further, when you are going to talk about the asset turnover, we all know that the assets or the infrastructure have been created in a company to facilitate different activities related to different functional domains, may it be production, may it be finance, may it be marketing, may it be logistics, may it be distribution, may it be the general administration orientation related to a business. But at the same time, unless the company is sufficiently added up with the requisite infrastructure in the form of assets, it is practically not viable at the end of the company to execute it to the best of their potential and to ensure that these activities are executed efficiently and effectively. Hence, the prevalence of assets in the business is very critical to the very success of business. That's why when we are looking at the financial states of affairs of a company, each and every company, irrespective of their size, scale, operation and sectors, they are always inclined to create asset base legitimately to facilitate different operating activities of the business. But on the contrary, when you are going to talk about legitimate creation of assets, there are heavy prevalences in the practical world of business that companies have created world class infrastructure, they have acquired world class assets, but on the contrary, they fail to make optimum utilization of all these assets so as to generate revenue, so as to generate the finished products, so as to facilitate different activities which are otherwise leveled under aids to trade so far as commerce and business is concerned. So it is imperative on the part of the users community to dig out whether the assets have been efficiently and effectively utilized to facilitate different activities, and specifically whether the assets have been utilized to magnify the sales and generation of revenue in one hand, and the assets are legitimately utilized to reduce the magnitude of expenses associated with different operating activities. So the second component almost talks about the creation of assets in one hand and the generation of revenue or the minimization of cost associated with different activities on the other hand. In the DuPont model, this is one of the significant component which facilitates the calculation of return on equity, to which the equity shareholders are mostly inclined to. Now, to calculate asset turnover, it is normally through the establishment of a causal relationship between sales and average total assets. Now, when you are going to talk about average total assets, here if the information pertaining to the opening and closing or the information pertaining to two different balance sheets are available at the end of the users community, it is easy to calculate the average total assets. But normally when you are talking about the returns associated with equity shareholders, specifically from the point of view of potential investors, it is not available so easily. So that's why in place of average total asset, if required, we may customatize it and we may go for the use of total assets related to a particular financial year to calculate the asset turnover ratio. Now, by establishing a causal relationship, we are more or less expressing assets and their efficiency with which these have been utilized in the business to generate revenue. Then moving to the third component, that is equity multiplier. It is simply calculated by establishing a relationship between average total asset and average shareholders equity. Now, again average shareholders equity can only be calculated provided 2 years balance sheet information will be made available, unless it is taken as the single year's financial statement and the single year shareholders equity. And when you are going to talk about shareholders equity, it is the sum total of equity share capital, the reserves and surpluses, the accumulated profit, the retained earning, less all those losses which are capitalized in the business. And we are there to quantify the shareholders equity by considering all those profits, the value of assets and all those returns which are more or less there in different heads of accounts through the protocol of appropriation of profit. Now, putting all these things together, we are into the protocol of calculating the shareholders equity. On the contrary, when you are going to talk about average total assets, again here we are going to talk about the fixed assets or the net tangible assets. Now, tangible assets represent those assets which are utilized in the business to facilitate different activities and specifically to facilitate the sales activity and production activity. Now, by establishing a causal relationship, we are there to dig out whether the assets are sufficient enough when we look at the equity shareholders return and their interest. Now, clubbing all these three components, all these three financial matrices in the form of financial ratios, we are in a position to quantify the return associated with equity shareholders by using the financial information getting disseminated in the financial statement. Moving further, when you are going to talk about DuPont model, we all know the terminology which is used essentially to predict. When you are going to foresee, when you are going to forecast, when you are going to estimate or predict something, we will make use of the terminology model. Now, we can go for DuPont model on a retrospective orientation, and at the same time we can go for DuPont model on a prospective orientation. Now let me start with the retrospective orientation when we are going to calculate the return on equity using the components of DuPont model by considering all these three subcomponents. Now these subcomponents are required to be multiplied in order to calculate the return on equity. As it appears, return on equity is equal to net profit margin into assets turnover ratio into equity multipliers. Now where return on equity, as I had already discussed, it is net income upon shareholders equity. Now net income upon shareholders equity, in other words we may say how much of return is made available to equity shareholders, and that can be calculated directly from the financial variables available in the financial statements. In simple way we may say that consider the net profit and thereafter make the payment of all those finance costs including taxes and dividend to preference shareholders, interest and all these things. Whatever residual return available at the end of the company belongs to the equity shareholders, and they are there having the orientation to make use of that as an act of reinvestment in the business, or they may take it in the form of dividend on a recurring orientation. Now it is up to the policy of the company what to do with the return available with equity shareholders. Now when you are going to quantify it by using the DuPont model, we are there to make use of the sub components of DuPont model, and I had already discussed these things in the previous slide. Moving further, when you are going to talk about the model, just as I hinted, essentially we are targeted towards the future states of affairs of a business, and DuPont model used both in the internal community of users as well as in the external community of users. So far as the internal users are concerned, the managers, the CEO, the board of directors, they are also equally inclined to know what is the return that is going to be made available to equity shareholders, because we all know that equity shareholders are having a voting right by virtue of the regulatory framework, and unless and otherwise the company is getting sufficient return which is going to be made available for the equity shareholders in the annual general body meeting of the shareholders, it is rather very difficult to convince the equity shareholders in terms of the return what the company is providing to the equity shareholders. So the internal users, say all the functional heads, all the functional managers, the chief executive officers, chief finance officers, they are also equally interested to ensure that sufficient return is made available to the equity shareholders, so that in the annual general body meeting of the shareholders they can convince and they can execute different policy decisions in a smooth and unbiased manner. But on the contrary, it is not always easy to do so owing to the vulnerable conditions to which the body corporates are exposed to. When you are going to talk about the external users community, say specifically the investors, they are more or less concerned about the future states of affairs of the business. They are paying attention to the retrospective orientation, the past performance, what the business is doing at present, how the business is doing at present, but at the same time they are more inclined and more concerned towards the future states of affairs of the business. Now future states of affairs, we all know, is bounded by hell lot of unpredictability. It is exposed and falling prone to different vulnerable conditions emanating from the market pervasive forces, and these market pervasive forces are beyond the control of the body corporates as they are macro by nature. and all the business entities are there to conduct and convening all the activities within that set off, and at the same time they are there to come out with sufficient return to satisfy the owners or the so called equity shareholders. Now the investors, when they are into the task of executing their decisions pertaining to investment, they are going heavy to dig out the future financial states of affairs by using all possible ways and means. Now, one possible way is to make use of the predictive DuPont model, which facilitates a scientific quantification of the return on equity which is expected to be offered to the equity shareholders in a future span of time. Now, the components would remain the same. When you are going to talk about predictive DuPont model, it is essentially the protocol of projecting net profit margin, asset turnover, equity multiplier and establishing a causal relationship. A predictive DuPont model predicts future ROE by concentrating on how each component can vary as a result of adjustments to internal operations, market conditions or financial strategy. It can assist management and investors in forecasting a company's future financial performance. In the preamble, I had already discussed why ROE has been given so much of weightage, because it is one of the most popular proxy used in the users community so far as financial performance is concerned. Now, as because it is one of the sensitive proxy of financial performance, and we are going to predict that proxy of financial performance, it is but natural that we are there to accommodate and consider all possible conditions which are emanating internally, all possible issues which are more or less going to have a bearing on the return associated with a company in a future span of time. So, there is no way out but to predict all these things, say market conditions, financial strategies and internal operations, and adjust the calculation or the prediction of the ROE owing to all sorts of conditions which are going to have an influence on the return that is expected to be generated for the equity shareholders. Moving further, when you are going to talk about the elements of a predictive model, specifically we all know that the predictive orientation is again going to accommodate those three classical subcomponents of the DuPont model. But prediction is a very difficult task, and that too specifically when you are going to deal with the financial variables, because the activities related to recurring ones, say production activities and administration activities, selling activities, distribution activities, they are always vulnerable to market conditions. Say for example, when you are going to talk about production activities, we are into the protocol of predicting the net profit margin, which is the first component of predictive DuPont model, and we are into the task of estimating what is going to be the net profit margin. Before we calculate the predictive net profit related to a future span of time, we have no choice but to go for the prediction of the revenues, which leads to sales forecasting. We have no means except to predict the different components of cost which are more or less reflecting different activities which are getting executed in the business to generate revenue. Similarly, we are there to predict how much assets are going to be utilized. Putting all these things together, when you are going to talk about the first component and its prediction, here I have jotted down some of the explanations, that is, examine past patterns in profitability, net income upon sales, and make predictions about future developments, cost control, pricing tactics and shifts in the competitive environment are a few examples of the variables that may have an impact on this. Now, on this particular subcomponent, when you are going to talk about the net profit margin, we are there to see to the fact that how efficiently we are going to curve on the vulnerability associated with different components of cost, because we all know the costs are emanating from the market itself. It is not in our control. How much we are going to spend towards raw material in the days to come, it is very difficult to predict and ascertain, because the price of raw material at which it is going to be procured subsequently in a future span of time is not going to be decided by the company, rather it is decided by the demand and supply side forces which are prevailing in the market. So, how are you going to exercise control over cost which is always on the verge of change? Similarly, when you are going to talk about the business environment, it is foolish and a rubbish state of affair if you are going to carry that what was the environment in which you performed in the past, you are going to perform within the same business environment. It is not going to happen in the pragmatic world of business, because the environment is always floating. It is always on the verge of change. So, how are you going to accommodate such changes while quantifying the net profit margin? Then coming to the second component, that is when you are going to forecast the asset turnover, which is essentially the proxy of the efficiency with which the assets have been utilized in the business, and to ensure that the assets are not in a state of idle orientation, because more the prevalence of idle capacity in a business, definitely less will be the extent and magnitude of efficiency with which those assets have been utilized in the business. But at the same time, we do not know what is going to be the quantum of demand associated with our product with which we are dealing with. Indirectly, what is going to be the sales? And after predicting the sales, we are there to check out the plans and policies in order to come out with sufficient units of finished products by using the assets. There may so happen that we are expecting to produce 1 lakh units, say for example, in a particular month, but our asset is not sufficiently equipped to produce 1 lakh units per month. So, you may take a decision to commit additional capital expenditure in the form of creating assets. So, all these things are related to a probabilistic orientation. We are not exactly aware, we are not that objective when you are going to talk about that is going to be our potential demand. So, when we are quantifying or predicting the potential demand, if our existing infrastructure does not permit us to meet that potential demand, we have to take that irrevocable decision with regard to commitment of capital in creating assets. But that is going to be too risky. We all know in the domain of finance, capital investment decisions are subject to heavy quantum of risk. So, when you are into the task of predictive DuPont model, we are there to see to that. Then coming to the third one, that is forecasting equity multiplier, when the company use a combination of debt and equity capital to finance the business. Obviously, we always expect that the assets are more or less created by using the debt capital, owing to the simple reason that debt capital is cheaper compared to equity capital. But on the contrary, we are there to be very careful that excess use of debt capital is going to magnify the financial risk of the business, and it is going to have a negative impact on the total return on equity to which the equity shareholders are interested. So, putting together all these things, when you are going to make use of DuPont model to predict the future states of affairs, by predicting these three components, and finally to estimate the return on equity. It is not going to be a simple states of affairs owing to the simple reason that there are different components which are imbibed in these three components which need to be predicted first, and we may be required to go for heavy use of statistical modeling to predict sales, to predict cost, to predict different other financial variables in order to come out with a robust output using the predictive DuPont model. I hope these discussions on DuPont model will provide you an insight through which you can make use of DuPont model to go for retrospective analysis of financial statement as well as to go for a predictive orientation related to a future span of time. Thank you for your patience.